Hi, everyone. Thank you so much for joining our webinar, where we will break down the recent proposed changes to the ESRS. I am Amy Rue, and I am Head of Product at Tracera, a sustainability data collection and reporting platform. And here with me today, I also have Vittoria Allegri, who leads Sustainable Finance at FTI Consulting. Thank you so much for being here, Vittoria. Would you mind starting with a quick introduction?
Thank you, Amy, and it's really a pleasure to be a guest for a second time in one of Tracera's webinars on sustainability reporting in Europe. My name is Vittorio Allegri. I'm a senior director in the financial services practice at FTI Consulting. And my daily job is twofold. On the one hand, I help companies comply with the complex EU regulations in the field of sustainability reporting in particular. And also, I support companies in engaging in the process of lawmaking as it concerns sustainability reporting framework in particular, but sustainable finance more broadly as well. And it's great to be here today. It's really a dynamic time in sustainability reporting regulations.
Yes, for sure. Well, let's dive into that and break it down a little further. So maybe the first question, just to kind of get everyone up to speed, what actually happened in July when EFRAG published the revised ESRS exposure drafts?
Yes, thank you. It's a very good question to start from. So, where do we stand in the overall simplification process of the sustainability reporting framework? Basically, we have two parallel processes ongoing. On the one hand, we have the legal framework, and that is being discussed at the moment in the European Parliament with very tough negotiations between political groups. And this revised legal framework foresees a revision of the technical standard underlying the legal framework, where the substantive disclosure requirements are provided, the notorious European Sustainability Reporting Standards. Because the Commission already anticipates that this work will need to be done, it has went ahead and asked the technical advice to EFRAG, which is the standard setting body in the European Union for sustainability and financial reporting. This is something that they are required to do by the legislation before they can adopt the technical standards into European law. So basically, what we have seen in July is EFRAG putting out for public consultation the draft of their technical advice to the Commission, which presents a number of substantial amendments to the European Sustainability Reporting Standards that had been adopted 3 years ago at this point. We will see in what way they are proposing changes, but basically what will come after is that at the conclusion of this public consultation, EFRAG will take into account the feedback from the stakeholders and then provide a final technical advice in November to the European Commission. When next year the revised legal framework will be in place, then the Commission will need to basically take this technical advice and put it into a legal act that will make it then binding for companies that are in scope of the new CSRD.
Got it. Great, great timeline overview. So technically speaking, so end of November is when the EFRAG will publish the final recommendations from a technical standpoint of the CSRD report. What does that actually mean in terms of the people who have to put together their report for 2026, let's say? Should they wait until this report gets published in November? Or should they be working on this original version of the CSRD, given that it's unclear when in 2026 this will actually be adopted into law?
Yeah, that's a very good question. So for companies that are already into the CSRD regime, the so-called Wave 1 companies, nothing has changed so far. That's the bottom line. So this draft, what we're seeing, does not have any legal value, nor we can assume for certain that this is the final draft. We can actually expect still a lot of discussions and changes. So wave one companies should really focus on picking up the work they have done for the 2025 reporting and continue with incremental improvements over that. And this will guarantee that even in a simplified standard context, what they have done will still stay relevant, will still stay compliant, but also add the value in terms of insights and information for the board and for external stakeholders as well. One point that's important to consider for the Wave 1 companies is the so-called quick fix that the Commission adopted also in July, if I remember correctly, yes. Which basically has extended the transitional measures that were included in the ESRS as we know it today, which basically said, for instance, that for biodiversity, even where it was material, it could be postponed by 1 year. It can actually now be postponed further. The same goes for the social standards on workforce or workers in the value chain. There was a possibility to postpone it, even if material. This possibility is now prolonged. They can still be postponed. So companies that have made use of these transitional provisions, they should check whether they want to make use of that if they can and they are able to.
Got it. So yeah, these relate to specifically questions where in the CSRD guidelines, it would say that they had a transitional window or that they could wait a year to report on it. So those topics are further delayed.
Yes.
What about for the wave two, for the stop the clock wave two companies? What would you recommend would be their best approach?
So this is where you have basically more variety of possible approaches depending on the company, right? So what I say, I might be a bit repetitive because I probably said this also during our last webinar, but is focusing on the no regret actions, right? So conducting a double materiality assessment will be useful regardless of your compliance.
Right.
Identifying key metrics and key stakeholders to engage during the process of identifying such metrics will be useful regardless of compliance and will be compliant whichever direction the ESRS changes in the future. So that is where really wave two companies can continue to focus. Hopefully they were already in the middle of preparations. At least I know many of them who were already deep into their preparedness process. So definitely keep doing that. Maybe, yes, take advantage of having extra time so that you can invest more into quality of the systems, quality of the internal controls, which will then down the line actually make way less painful the audit process, which we heard from many companies has been not as smooth as they would have liked. One point for wave two companies or former wave two companies is also keep a close eye to the political negotiations and try to make an early assessment as to whether you are still in scope or not. And then basically work on the basis of that, because the implications could be significantly different in terms of your preparedness, how you engage with your business partners, and also how you engage with your statutory auditor.
Makes sense. And if you're likely going to still be in scope, then similar to the wave one companies, would you recommend that they still use the current version of the CSRD as the base, given that that's the one that's only legally approved? And then maybe take into account some of the things we'll go through today as items that could be potentially simplified as suggestions, but it's still a little risky for them to take that as the source of truth. Or
Yeah,
how would you recommend
it's a very good question. So what we are like when we work with clients that are preparing for future reporting under CSRD, we use the ESRS as it is today because we work on the assumption that the benchmark is going down and not up. So having a high quality double materiality assessment conducted using the current standard sets you up for having a compliant double materiality assessment in the future as well, like I said earlier. So yes, using the current ESRS, especially when it comes to the double materiality assessment, so the foundation of your reporting, makes the most sense. When you then go down into the topical standards, that's where you might say, okay, rather use what has now been called this top-down approach. We might touch upon that in shortly, but basically focus on what makes the most sense for you in terms of disclosing impact, risk, and opportunities specifically, rather than using the data point list as a checklist, as some more zealous companies have been doing so far. That's where you can kind of disregard the existing ESRS and rather focus on the substance of what you do in a non-regulated environment, basically.
Great. Awesome. So now let's dive into what actually changed. So for this section, I was hoping maybe we can focus first on high-level changes, especially to ESRS 2, and then we can dive into each of the sections related to climate change, water, social topics, etc., and talk at a high level the big changes.
Yes.
So yeah, first of all, what's the most notable change, especially for the general disclosures?
Yes. So what I would say in terms of the general disclosures, actually there's one step even before in terms of significant changes, which are the principles for disclosures. So the introduction of new important principles that really change the lens through which preparers should approach the sustainability reporting exercise. And in particular, the change from a compliance approach to a fair presentation approach. And here, basically, EFRAG is picking a principle that has long existed in financial reporting, that of fair presentation, which also involves the fact that fair presentation is in the management point of view. And so this really gives a lot more, let's say, flexibility, especially when the auditor is checking the disclosure. Because it is not checking in a very granular, line by line, comma by comma, as we have seen in some CSRD assurance engagements so far, but rather in a more holistic way. Does the report give a fair presentation of the company's material impact, risk, and opportunities? So this is really changing the approach and hopefully should really address one of the first concerns that Wave 1 companies had been expressing. The other important principle that has been introduced in terms of simplifying the entire approach is that of undue cost or effort. This is a new principle that basically states that the company should only disclose information, even if the information is material, only to the extent that the information is available to the company without undue efforts, basically. And where the company cannot reasonably retrieve this information, it is allowed to use estimates. So this is really now stated, even if some might have said this was implied in the existing standards. This is now explicitly stated as a relief clause that preparers can use again when they approach with their auditor. This is really important for the way the entire exercise is approached.
Yeah. What are some examples of those data points that you see people claim that there's an undue effort?
Well, the most famous one is the scope 3 emissions, obviously. Maybe not so obviously, but yes. So a typical example of this is companies complaining about the difficulty of retrieving and collecting reliable scope 3 information, basically, for disclosing their scope 3 emission. So this is one of the key areas, let's say, where most companies will have to ask themselves the question, okay, do I apply for this relief? Will I rely only on estimates and maybe make plans for the future when the system might have become more mature? Or do I go ahead and try to collect wherever possible scope 3 information directly from my value chain? So this is the first example that comes, I would say, to mind.
Mm-hmm. Makes sense. All right. So then, going back to the original question of the general disclosures, what
Yes.
is the most notable change there?
Yes. So another important, like the changes that then come when it comes to the general disclosure is, well, first of all, that you have what I called earlier, this top-down approach and this materiality of information filter, where basically nothing anymore is always mandatory. You always have this materiality filter where basically you only focus on the impact, risk, and opportunities. Whereas the lack of clarity in the previous standard was whether, if a topic is material, do I need to go through each, let's say, aspect and data points that relates to that topic, or do I only focus on my own company specific impact, risk, and opportunities derived from that topic, and that are sort of established by the preparers themselves, established by the management themselves, as opposed to coming from a long checklist, basically. Then when we go into the actual disclosures, there's a number of these disclosures that have kind of changed, but the most important one is the change of the minimum disclosure requirements into general disclosure requirements, where basically, whereas companies before would have a long list of mandatory disclosures where they may not have had policies, actions, and targets as regards certain IROs, now they can simply omit the disclosure where they don't have such policies, actions, and targets, basically. So it is much easier for a company to make a judgment call and say, well, this particular topic, this particular IRO, yes, I recognize it is material, but I'm not doing anything about it at the moment.
Mm-hmm.
So this becomes much easier and much clearer, much more clearly stated. Another point that I think will help a lot, or actually 2 points that will help a lot. One is connected to this, and it's the elimination of the duplicative disclosures between topics and general disclosures, which was adding pages and pages of basically information that was contained twice, once in the general part of the report and once in the topic specific part of the report. So that is now eliminated. Um, sorry about that. And yeah, and then this elimination of the voluntary data points. Those voluntary data points, in my experience, were mostly creating a lot of confusion, because like, are they really voluntary if they are identified as material? And then why are they why are they worded differently than the other data points, if in the end the materiality assessment makes the determination whether or not the data point should be included in the reporting? So ultimately, removing those voluntary data points, bringing them rather into the illustrative guidance that is separate and not a legal text, basically, in my opinion, really helps a preparer to say, okay, this is an example. I look at that as an example, and does it make sense in my context? If yes, then it's helpful, then I will take it. But if not, then I will feel much safer if it's not part of the legal text, basically, legal technical standard. So for me, that's for the general disclosures. There might be a few smaller points, but these are, I think, the foundational parts.
Yeah, makes sense. And when you say the voluntary requirements, you refer to the application requirements, what they were previously referred to as. Awesome. All right, I think we might have time to maybe just touch on climate change a little bit. I don't know if we'll have time to go through every single topic, but we will be posting a white paper of sorts afterwards where we go through each of your topics in detail. So please keep an eye out for that. But given climate change is such a big part of everyone's headspace when it comes to this reporting, maybe you can run through some of the key changes or simplifications on the climate change side.
Yes. So I think we can here see two very important and very significant changes. On the one end, the organizational boundaries. So the fact that the new standards have changed from financial control to operational control allows companies better and, let's say, more discretion on what entities and what activities they want to include into their emission accounting, basically. And then the other bigger change in terms of the climate standard is the strong simplification of the transition plans. So reporting on transition plans in the in the original ESRS contained a lot of very granular elements which a company was expected to disclose about their transition plan. And basically, many companies, they were reverse engineering the transition plan based on the disclosure, because not like it may not cover all of the required elements that were contained in ESRS, because maybe you already have an existing climate transition plan. As it is now changed, this makes it much easier. It only covers a few key elements, but the rest is delegated to the company. The rest is really up to the company to describe the transition plan that they have formulated. And one last point I would like to make on climate change reporting is, and this will likely feature in the ongoing public consultation and is a topic of discussion already, is the risk of losing the alignment with the international standards. So whereas currently a lot of effort had gone into alignment and convergence with the work of the ISSB, for S2 in particular, what has happened now that has that puts this alignment at risk is the removal of the disclosure on anticipated financial effects. So this, of course, is very much welcome by the preparers, because it was a it is a very difficult exercise to make a robust forecast of the anticipated financial effects of climate change, especially if you are not, let's say, in a sector that is widely and and deeply studied the correlation with climate change. Now think about energy, but other sectors, almost like many other sectors, are struggling to understand the correlation and give a quantitative value to the financial effect. So this is a welcome simplification on the one end, but on the other end, it undermines one of the fundamental objectives of the CSRD and more in general of sustainability reporting, of providing the investor with decision useful information for investment decisions, which is what the ISSB S2 is really focused on, basically. So here I see, whereas the rhetoric of the European Commission would always be, we are maintaining the objective, we are still going to use CSRD to influence the financial system and use the financial system for improving climate risk management. If you remove the very piece of information that would allow that, you put that objective at risk, let's say.
Yeah. Isn't some of that already covered with the financial risk side of the TMA assessment process? Or do you think that you can go a lot further than that in terms of the financial impact assessments?
I mean, yes, it is covered on a principle basis. So I can make, say, a thought exercise about what will happen in the case, in let's say in a scenario of extreme weather events with physical risk, in a scenario of carbon pricing policy, etc. But I don't need to give it a quantitative value that would then, in some cases, be reflected into the impairment of assets in the financial statement.
Right.
So it doesn't get to that level of detail that would be needed to give an investor the information they need.
So potentially the biggest point of discussion during this consultation period then.
It is one of those that I have seen the most emerge. Of course, you have to also kind of put in context that these consultation, these reporting standards are technical, but are really closely followed by a wide variety of stakeholders, from investors and companies, but also civil society stakeholders, who are already taking aim at the very important reliefs that we have discussed in the first part of this webinar. So those, I also would expect some criticism to come, let's say, when there is the perception of too much simplicity in omitting potentially relevant disclosures.
Yeah, awesome. All right, well, just kind of stepping back now, for companies who are thinking through how should this impact their internal systems or their internal processes that they are setting up to work on CSRD, how would you recommend they think through these changes as it relates to internal controls, processes, as well as data systems that they're using for this process?
Yeah. So this is a very good question. The simplification process has a potential downside in that the reporting process is much more personalizable by the company. It sacrifices a little bit of that comparability and that kind of standardization to give the preparers more room for judgment, which is positive, but at the same time, it requires a better substantiation of that judgment, basically. And therefore, as you look at the tool, you want to look for a tool that is really able to change according to your own impact, risk, and opportunity, that is really flexible to adapt to the way your organization structures a DMA process, structures a data collection process, and then which data in particular. So really, I think that flexibility of tools when choosing a tool and of processes and governance as those are being designed is really important. On the one hand, because the new legislation will give that flexibility, will give that possibility to adapt for your own organization. But also because it's subject to change. So definitely the other important thing is hold on, kind of focus on business first priorities and closely monitor how the changes go until you have a more, let's say, robust draft to work on the basis
Yeah.
on what you can work, basically.
Yeah. I know we're at time, but one final question I have is, do you see this as a sign of just regulatory maturing, or is just a tactical easing given the political climate today?
So it's a very political question, so I will try to give you a political answer. I think what has happened, if you zoom out and look at, say, a 5-year perspective, the EU at the start went very much ambitious, very fast. To the point that it might have, let's say, exceeded what the business community was ready for, in particular when it comes to those mid caps that may not have had a sustainability reporting or a sustainability consciousness already. So what is happening now is recalibrating. So you call it maturity. I think it's a good way of putting it, but it's a recalibration of what is realistically achievable within the timeline, so that at least we can start somewhere and then evolve to a system that is, as was the original intention, is at the same level of financial reporting, but there has been over the past year a realization that it will take a bit longer than what the original ambition was.
Got it. So we're breaking it down into steps now. Awesome. Well, thank you so much for your time, Vittorio, and thank you everyone for participating and watching this webinar. And we will be in touch again with other content in the future.
It has been a pleasure. Thank you.
Thank you. Bye.
Bye.